Hello and welcome to the Mutual Fund Show. My name is Neeraj Chai. In the next 20-25 minutes, we'll try and talk all about mutual funds. This time around, we'll talk about a strategy. We hear from enough and more people about when is the right time to get into markets, when is the right time to get into funds, when you should buy. We don't often talk about selling. We've done a piece about 2 months ago about the importance of selling at the right time. But how about there being a strategy which tells you that about the right time in terms of the numbers or numerical time wherein you should get out of the markets or get out of your investment in order to take some money off the table in order to enhance your returns, because it's not just about the numbers, it's also about the investment behavior. Are you confused? Well, let me not try and confuse you any further. Let me try and simplify it. Vijai Mantri, Chief Investment Strategist at JRL Money, joins us right now on the show with what they call a safety wall strategy, and what in essence means, Vijay, a targeted return strategy, right? That's the essence of this. And why is it that this becomes so important? From a behavioral perspective, before we get to this whole topic.
See, I think theoretically it is known as value averaging, the flip side of SIP. And in our opinion, there are basically 4 ways to make money in the market. Number 1, and the best, is actually buy and hold. But the buy and hold strategy have its own challenges, because we have seen in past 1 year, 3 years, even 5 years, the mutual fund has delivered suboptimal return. There's a phase. And this phase comes after the market has have a huge rally. We have seen post-2008, we have seen post-2000. For 5 years, there's no return in the portfolio, not even beating bank deposit. But if you hold for longer period of time, 7 and 10 years, then the probability of beating bank deposit is almost 100% in most mutual funds. So buy and hold is the best strategy, but it comes with own challenges.
Because the investor is not able to digest the volatility.
Investor will not digest the volatility. The data clearly suggests that when the investor see return on the fact sheet, at that time the maximum buying of mutual fund happens.
Yeah, well, it's not just mutual funds, right? In stocks.
It's everywhere. Stocks and real estate, gold. Whenever there's a people see immediate past returns looks great, that is the time the buying happens. And an inevitable thing happens that the law of average catches. So the one way of investing, buy and hold. But it is, in my opinion, the best strategy, provided you understand the risk involved in it. The second strategy is to you do on a base of view-based investing, where the government will do something, what kind of budget will come, who will form the government. And the challenge with this kind of strategy is that sometimes you can be right, sometimes you can be wrong.
Most times you'll be wrong.
No, it's not. Unfortunately not that way. If most of the time you are wrong, then you can go and tell people that do exactly opposite of what I'm suggesting you to do.
Yeah, but no. Okay,
so it's not that easy actually. You can't be more than 50% wrong. But if you order 50% in business of investing, then actually it's zero-sum game. You don't make money. The third strategy is to look at market fundamentals. So you look at the PE multiple, you look at the price book value, you look at dividend yield, you look at the yield gap, you look at GDP to market cap. Now the challenges with all these data are that they give contradictory signals. So today, PE multiple is telling you market is overvalued. Price to book is telling you market is undervalued.
Yeah.
The second question with these data is that what data should you take? Should you take past data? Should you take forward data? And definitely this strategy cut the volatility, the fundamental basis investing, but also cut the upside return. What most investors understand very simplistically, how much money I'm making. So this is a target return strategy where we have designed it. It is very popular strategy theoretically called value averaging, but practically it is very difficult to implement. And we spent close to 3 years figuring out how to implement it. And today we are ready to implement it. So how this strategy work is that you do counterintuitive thing. Basically, most people invest when the markets are rising and take money out when the markets are falling. The best monies are made when the markets are falling, you invest, and when the markets are rising, you sell. But nobody can do it. It actually is easier said than done. So we have created a structure. This structure forces investor to behave in a disciplined way.
Okay.
So this is the theme. And it is the first time ever in India, this kind of a strategy perhaps is being discussed on a media, and I would like to compliment Neeraj and your team for taking this up.
Well, whatever helps our viewers, Vijay, that's the whole idea, right? Isn't it? So this is this is in simple words a targeted return strategy. You set a target for yourself.
Yes.
And the target could vary, but you choose a target of 10%, let's say. And once you hit a particular target, you take some money off the table. Is that the simple way? And then we'll of course explain the strategy as well.
So what it does is that it asks investor, and basically it is a discussion an investor should have with his financial advisor. What should be my targeted return in equities? And we are right now talking only about equity, and I'm talking about mutual fund. So someone say 10%, someone say 12%, someone say 14, 15%. So whatever is your target, you take the target. So what you do, you put lump sum money in a mutual fund scheme. Let's say you have taken 12% target. Suppose you invested 1 crore rupees in a mutual fund scheme, and your target return is say 10%. So after 1 year, the 1 crore should have become 1 crore 10 lakh rupees. But suppose at that time 1 crore is not 1 crore 10 lakh, but the 1 crore has become 1 crore 30 crore, 1 crore 30 lakh, 1 crore 40 lakh. So whatever is in excess of 1 crore 10 lakh, you take money out. You only take the excess out. So suppose you see the sheet here. Here we have taken an index fund. So we have assumed that someone started on 1st January 2006, and that person set a target return of 10%. So at the end of 1 year, from 1st January 2006 to 1st January 2007, this 1 crore should have become 1 crore 10 lakh. Now, but actual value is 1 crore 37 lakh rupees. So you have an excess.
This is an actual example, right?
Actual illustration.
Okay.
So you have a 27 lakh rupees excess. So what you do? You take out 27 lakh rupees at that time. Then you track this portfolio on monthly basis.
Okay, wait a minute. So let's go step by step. You withdraw this 27 lakh rupees
and put
on
that
the
in liquid
chart.
Fund.
It is mentioned 27,11,815, and you put that in the liquid fund.
Yeah.
The reason being, liquid fund gives a slightly better return than a savings bank account.
Yes, liquid fund gives 7%, around 6 to 6.5% to 7% return. But the second purpose of this strategy is that not only you take money out when the markets are rising, but when the markets start falling, then you dip money from the liquid fund and feed back into equity fund.
Yeah, but I mean, you can do it out of the bank account as well, but we are saying a liquid fund because it's slightly better.
That is very difficult to do, because when the money is gone into customer's account, and when the markets are falling, nobody want to touch that.
Okay, so you're actually advising that put all the money that you withdraw in a liquid fund.
In liquid fund.
Okay, so that's the first thing. You remember when you withdraw from a liquid fund. Now, if you can have the graphic back, so January 1st, 2007, which is 12 months after your initial investment, theoretically, or actually factually in this case in an index fund, the value had actually become 1 crore 37 lakh rupees.
Yes.
So you've withdrawn 27 lakh rupees out of that.
Exactly.
What next?
What next? Then you, after 1 year, you observe it every month. So every month, since you've taken a 10% target, so next month it has to grow by 0.87%, because we are compounding at monthly basis. So it's around 0.87 basis point.
Okay.
So next month, this should have been at 1 crore 10 lakh 87,000 rupees. Your targeted money should have been there. But the 1 crore 37 lakh, out of which you've taken 27 lakh, 1 crore 10 lakh as next month has become 1 crore 14 lakh.
Okay, it had become 1 crore 14 lakh then.
Exactly. So it's gone up, market has gone up, say 12% around that time. So what you do, the excess, the difference between 1 crore 10 lakh 87,000 and 1 crore 14 lakh 53,000, the excess money of 3 lakh 65,000, you take out at that time. Then next month again, the 1 crore 10 lakh 87,000 also need to compound at 87.87%, because 10% is annual CAGR. The money should have been 1 crore 11 lakh. But the next month the market has fallen. So the fund's NAV has fallen. So the value has become 1 crore 3 lakh rupees. Your expectation was 1 crore 11 lakh rupees. So what do you do at that time? Whatever money lying, you are around 31 lakh rupees lying in liquid fund. So take out 8 lakh rupees out of that liquid fund and claw back into equities, and then you track it on month basis. So when the markets are rising, you take money out. When the markets are falling, you feed into equities.
From that liquid fund.
From that liquid fund.
Okay, so March you put in some money. April again there was a shortfall because the actual target value should have been 1 crore 12 lakh rupees, and it was only 1 crore 11. So you invested a shortfall of 1 lakh. And then again in May, in this case, which is an empirical evidence of course, in May 1, 2007, the number should have been 1 crore 13 lakhs, and it actually became 1 crore 20 lakhs. So again, the excess of 6 lakh 91,000 was withdrawn
You're taken out.
and put it in the liquid fund again.
Fund, okay.
And the process continues.
And the process continues. So if you just look at this illustration, you started with the NAV of around 28 rupees in this index fund.
On January.
On Jan 2006. After 1 year, the NAV became 38.48. So you took out 27 lakh rupees, the NAV of 38.48. Then the NAV became 40 rupees. So again, you took out more money. Then the NAV fell to 37 rupees. You clawed back the money which you've taken out at 40 rupees and 38 rupees. Then NAV again fell to 37 rupees. Again, you took 1 lakh rupees and feed it back into equity fund. Next month, the NAV has become 39.89. Again, NAV rose. You took money out. Again, in next month, June 2007, again, NAV rose to 41.87.
Sure.
Again, you took money out. So what does it do is that in the rising market, if the market is rising more than your expected rate of return, you are booking part of the profit and feeding into liquid fund.
Got it.
And whenever the markets are falling less than your targeted return, then you take money out from the liquid fund and feed into equity portfolio. So this is how the system works.
How long does this? How long does an investor continue doing this?
This you can continue forever.
Okay.
Because the longer you stay invested in this kind of strategy, what this study does after, for instance, 5 or 7 years is that money at risk become almost zero. What does it mean? That your 1 crore you invested, you've taken out the entire 1 crore rupees. So the money lying in liquid fund is more than 1 crore rupees, but there's still money available in the equity scheme because you took money out when the market was booming.
Sure, okay.
So the 5 to 7 years, then the money at risk almost becomes zero.
Okay. Now, viewers, remember, past performance is not a guarantee for what the future returns would be like. But based on an index fund in the past, which in 2006 and 2007 did this, the empirical evidence suggests that these are the numbers that it could have thrown up. Now, Vijay, have you guys tested this for performance appraisal as to whether this strategies work better than some of the other strategies?
See, as I told you in the beginning, the buy and hold is the best strategy. But investor return and a fund returns are two dramatically different things. So fund may deliver very good return, but investor haven't got those kind of return. And the very critical part is the behavior of investor himself. And now one can't go and teach investor how to behave. So you need to create a product and structure which takes volatility away and improve the performance for the investor. So it does wonderfully well in most market situations.
Yeah, well, I think the data that we have shows that it's actually done better even in a buy and hold strategy, because the return from the targeted return strategy is in the peak, Jan 1009 about 10%, March 2009 about 19.2%, and August 5th, 2015, presuming that people have stuck through it, would have been 9% versus 8.2% in the buy and hold strategy.
Yeah. So let me explain you this. So what we did is that we took 4 market scenario: peak, the bottom of the market, and the sideway market. So market peaked, say, January 2008. Suppose you started investing through this strategy. From that date till today, the IRR on equity component is close to 10%. The IRR on buy and hold strategy is 5.3%. Then we looked at the bottom of the market. So market from 6,000 on Nifty came to 3,000. Suppose you started on that day in March 2009. Suppose you started, one-time investment delivered you 15.3% CAGR over a last 10-year period.
Which is not bad.
But provided you were able to catch March 2009, where there was a complete negativity and everybody was giving a very bad review of what will happen to Indian economy. People were away. And actually mutual fund numbers will tell you at that time the mutual fund net sales numbers were almost negative.
Sure.
Okay. This strategy, even in this, the equity component delivered 19.2% CAGR. Then we looked at, again, Jan 2012. From there, this strategy IRR has been 14.1% against 13.2% of buy and hold. And again, when the market touched 2015, in August 2015, when the Nifty, I think, close to 9,000 numbers it showed. And from there, buy and hold delivered 8.2% CAGR, and this strategy has delivered close to 9% CAGR to the investor.
So why do you say buy and hold is better than this?
Buy and hold is better because there are some time period. Suppose you're able to catch the bottom of the market. From there, the Nifty has gone up 5 to 6 times. Now, in this strategy, after 1 year, suppose in March 2009, you invested 1 crore rupees in buy and hold. In 1 year, the market almost doubled. So what you did, your 1 crore has become almost 1 crore 80 lakh rupees. In buy and hold, you kept 1 crore 80, 1.8. In this strategy, suppose your target return was 15%. So in excess of 1 crore 15 lakh, 65 lakh rupees you took and put in liquid fund. That 65 delivered liquid fund return, but the 1.8 in 100% equity continued to grow. But they also were subject to higher volatility in the portfolio. So right thing to look at is, even in that strategy, is look at absolute value of the portfolio. So if you go back to the same IRR graphic, I'll explain you.
Yeah, sure. We'll get the graphic up on the screen.
Okay, now if you look at the peak of January 2008, when we are saying this strategy delivered 10% CAGR, the total value of amount of money invested through the value of the investment is 5.3 crore through this strategy. And the amount principal invested is 2 crore in this strategy.
Okay.
Because when the market fall, suppose you invested 1 crore rupees and after 1 year market fell 50%, then at that time, my strategy asks you to pull more money out of a saving bank account or wherever it is available. So on 2 crore rupees investment, your portfolio value is 5.3 crore. In buy and hold, 1 crore investment is 1.82. So this strategy, you invested 1 crore more, but this strategy
Returns were
delivered
much
you
higher.
3.5 crore more for 1 crore additional investment.
Yeah.
So that happened in the peak of
3.5 crore on 2 crores. And this...
1 crore has become 1.82 in buy and hold.
Yeah, sure.
This strategy asks you 1 more crore rupees.
Yeah, precisely. So on 2 crore investing, your total become 5.3 or thereabouts.
So the additional 1 crore added 3.5 crore rupees to you compared to 1.82 in the buy and hold strategy.
Fair call.
But that was the peak of the market. Now let's see what happened at the bottom of the market. So if you look at March 2009 data, 1 crore investment in this strategy is 4.75 crore. Okay, 1 crore in buy and hold is 4.5 crore rupees. Okay.
Not too much of a difference, but that is only if you can time the bottom of the market.
Only if you can time
which is
the
very,
bottom,
very difficult.
Which is very difficult. And if you look at other strategy, again, is continue to add more value in various market conditions.
Okay. Now, here's just one small distinction that I feel out here. This strategy, I think, remember, we've done a show in the past when we talked about how if the market multiples reach a particular level, that investment strategies that said you should book out of profits then. This strategy, the good part about this strategy would be it doesn't really talk about the P multiples, which are difficult for people to ascertain what the nifty P multiple might be. It's a targeted return strategy. If it reaches a particular target, irrespective of the market multiples, then skim some money off the table. Now, Vijay, my question to you, a follow-up question to you is this. There are a lot of people have advised that if you have lump sum money, a systematic transfer plan is a great option. Now, let's say people buy that argument that an STP is a good option. Can someone club this strategy if someone wants to do an STP? I mean, how do we compare a systematic transfer plan and then try and combine this strategy within that?
So before that, let me answer one more question. The illustration which we took right now of 1 crore become 1 crore 37 lakh rupees, the reverse can also happen. The 1 crore could have become 60 lakh rupees or 50 lakh rupees. The question people then have is that I don't have money at that time.
Yes.
So your strategy will ask you to put 50, 60 lakh rupees, so I don't have money at that time.
Legitimate.
So the counter argument, so the solution to that is that if you have 1 crore to invest 60 lakh rupees into equity, keep 40 lakh into liquid fund, and then observe it. So after 1 year, suppose 60 become 40, then you have money you can plow back from the liquid fund and put it back into equity scheme.
Okay.
Your question on STP is very interesting. Suppose you have 1 crore rupees to invest in a index fund or any fund. So we generally advise 12-month STP, 15-month STP or 18-month STP. For our assumption, we have taken 15-month, for our assumption, we have taken 18-month STP. So per tranche is 5,55,000 rupees. Again, you suppose you take a target of, say, let's assume 15% CAGR you want to make. So what does this strategy do? Now, if you look at this illustration, 1st January 2008, we have started with 5,55,000 rupees STP. In normal STP, this 5,55,000 remain fixed for the entire tenure of maybe 12 month or 15 month or 18 month. What this strategy does for us is that you take 5,55,556, and then for next tranche, what it does is very interesting thing. Suppose you have taken 15% CAGR as your target return. This 5,55,000 next month should become 5,62,000 because you want to grow at 15% CAGR. But actual value of portfolio is 4,67,000 because the NAV of the fund has fallen from 59 rupees to around 47 rupees.
Again, this is an actual example, and the NAV of the fund had fallen then.
This is an actual illustration.
Okay.
So what has happened that you started at the NAV of 57.39. On 1st Feb 2008, the NAV has fallen to 48 rupees.
Okay.
So the value from 555 has come down to 467.
Okay.
Now your target, your expectation was 562, but it is 467. So next trend should be 555 plus the difference between these two. 562 minus 467, so around 95,000 rupees more you added.
Okay.
So you did 555 ka tranche at the NAV of 47 rupees, but when the NAV fell at 48 rupees, instead of 555, you invested 1 lakh more.
Okay, so your total investment became 650,349.
Then again, we looked at the same next month. Next month, the NAV has come down to 46.84. Now, on total investment of yours, you should have expected 1130 as the value, but the value is 10.84. So next month, you invest around 56,000 more. Same thing can happen in April 2008. When April 2008, NAV fell to 42 rupees. So in that month, you invested 7,33,000. In May 2008, NAV rose back to 46 rupees. So in that month, you invested less amount of money. So even in STP, instead of doing a normal STP, this structure allow to do STP through this safety wall strategy, where if the NAV is more than your targeted return, you invest less, and the NAV is less, then you invest more. On average, 80% plus of the time, compared to normal STP, this STP add anything between 0.5% to 1% additional alpha to the portfolio of investor, while at the time just feeding into equity funds.
Okay, so you've again done some calculation. Let's run through them very quickly.
Yes.
This gives good returns.
Absolutely.
Okay, can we have? We should have those numbers on the screen as well. But again, there's a performance differential from the peak, trough, and peak. The similar thing that we did the last time. And I presume you can clearly see that while the difference is not dramatic as compared to the other one, there is still a difference.
So there's a difference of we are adding 80 basis point in most cases, 80 basis point to almost 1% in most cases.
Yeah.
So in an index fund, if you're able to add that kind of value to the investor, and it's CAGR, it is not a
it's
so
not a
it
one
has
time,
grown from 2008. We are looking at 11 years, and in 11 years, suppose I'm able to add 60 basis point to 1% to the investor's overall kitty. And not only I do that, but at the same time, I reduce the volatility very, very significantly for the investor. Then I think we have done a decent job for the investor.
Yeah.
So there's a strategy even work in STP. So how to use this strategy? One is that if you have a lump sum to invest, then our advice to split into, if you want to feed into mid and small cap, then 60% should go into mid and small cap, 40% should go into a liquid fund. Suppose you're doing in a large cap fund or multi-cap fund, then 70% should go into large and multi-cap fund, and 30% should go into liquid fund. That's the one part of doing it. The second way to participate in this structure is that if you say, whenever you need money, I can give you money. So then you feed into this fund straight away 1 crore rupees wherever you want to invest. The third way to participate is that you have lump sum money, park that lump sum money into liquid fund, and then feed from liquid fund to equity fund using this strategy. On an average, 0.5% to 1% alpha will be added to your overall IRR.
Okay. Now, viewers, remember, this is not easy work because it has to be monitored on a monthly basis. So maybe consult your financial advisor if they can do a strategy like this. Make them see this and see if they want to do it. Or I guess the guys at JRL Money might have it. But the larger point is this, that data suggests in certain cases, or if history of an index fund is to be seen, which is a simple thing to do, choose an index fund because it will move in line with the markets largely, then a targeted return strategy works much better. Vijay, we are out of time on the show, but very quickly, just one follow-up question. We've discussed this topic of targeted return very well. Just one question that I had for you, because I heard a couple of announcements from people, or a couple of conversations wherein people are being sold perpetual bonds. And yeah, you have some thoughts here. People should keep in mind a few things before going out for buying into perpetual bonds.
It's very interesting. The same bunch of people who sold ILFS FD, ILFS debentures are actually now, or DHFL FDs are now telling people to buy perpetual bond. And why perpetual bond? Because you've seen challenge on the debt mutual fund, you've seen challenge on the corporate FDs, the bank deposit rates are coming down. So if SBI bank deposit rate is 6.5% and SBI perpetual bond rate 8.5%, 2% extra return, no brainer, go and invest. So that is a very simplistic explanation given by people. If a normal people give this kind of explanation, no problem. But financial advisor talking about it is a bit, I think.
No, but why are you saying people should be? What should people keep in mind? Just that, very quickly.
Three things people need to remember. One is that these are not bonds. These are not secured as FDs or money lying in saving in a current account. It's a tier 2 capital. So it's a quasi equity, point number one. Point number two, these are perpetual only from the customer side. Banks can call it back any time after 5 years in most cases. So one need to keep that in mind. So suppose you 100 rupees bond, you bought at 105. And after you bought it, suppose within 3 months bank calls it back. Then the bank will only give 100 rupees. The bank will not give 105 rupees. So your capital loss, potential capital loss of 5 rupees. The third factor people need to keep in mind is that there's a very clear proviso in the offer document of this bond that in a year in which the organization or bank doesn't want to declare interest or want to pay interest for whatever financial reason, then that year interest is foregone. And it is not a default. So it is not that it will get accumulated and paid in next year. Once it is not declared, it is foregone. The fourth factor is that in an eventuality of weakness in the financial of that organization, then part of these bond can be capitalized. So suppose you have invested 1 crore in those bonds, and suppose 20% of that get capitalized, then 20 lakh rupees become the capital of the bank, and you have only 80 lakh rupees liability. So if you're buying these bonds, keep these things in mind before you plunge into it.
Okay, well, that's an advice. Vijay, thanks so much for giving us that, and thanks so much for this strategy. I hope people who find merit out here make use of that. But with that, it's time up on the Mutual Fund Show. Vijay, thanks for joining in, and viewers, thanks for tuning in to this leg of the Mutual Fund Show. Stay tuned to BloombergQuint.